Thank you, everyone, for tuning in. My name is Corey Hoffstein, Chief Investment Officer and CEO at Newfound Research. And it is my pleasure to be joined today by Oded Shimoni, Managing Partner at AlphaBeta, and Gideon Amoils, Quantitative Portfolio Manager at AlphaBeta. And we are going to do a deep dive into their systematic merger arbitrage index. Gentlemen, thank you for joining me. Let's start off with the simple one here. Can you guys introduce the Alpha Beta Investment Indices team, provide some background, explain your expertise in merger arbitrage? My guess is most people tuning in today maybe haven't heard of you before.
So let me give a bit of a background of the company. So we're a quantitative asset management business specializing in systematic investment strategies. The firm has a few lines of business. We've been at this for about a decade, several business activities, including running global long-short hedge funds and systematic indices. Merger arbitrage specifically has been a part of our toolbox for a while. We adopt what we think is a pretty unique quantitative approach to the strategy, leveraging both traditional ideas and more advanced analytics. We keep refining these types of approaches alongside the development of more tools and strategies. And with me here, as you mentioned, Corey, is Gideon, who would do most of the talking. So Gideon, you want to introduce yourself a bit?
Yeah, sure. Thanks, Oded. So I've been with the firm for about 3.5 years. My job is that of a quantitative portfolio manager, and I work on building the quantitative strategies and managing those strategies in the funds.
So for folks who are maybe unfamiliar with merger arbitrage as a strategy, let's start there. Can you give us a high-level overview of what merger arbitrage is and how it typically generates returns?
Yeah, sure, no problem. So merger arbitrage is an event-driven investment strategy that seeks to capitalize on the spread between the market price and acquisition price of a target company in a given mergers and acquisitions deal. So how does it work? You have its stock traded in the market. One day, an acquirer comes along and offers to buy that stock at a given price per share. The stock will tend to jump on announcement. Then it'll also tend to still trade at a discount to that acquisition price. And why is that? Because there are still two components which need to be taken into consideration. One is there's still time to completion. The deal will be completed in a few months' time. And for that, investors need to be compensated with the risk-free rate. And the second, more critical component is the idiosyncratic risk in the deal. Now, this is the risk that the deal might fail. When we're talking about risk of deal failure, the main factor would be the regulator. In order for a deal to go through, the regulator needs to pass through several stages of regulatory approval. As the deal passes these stages, what tends to happen is that the price of the target company will converge towards the acquisition price in the deal. And once all the regulatory phases are completed, and the deal will approach and reach the acquisition price. So that in general is how it works. It's convenient to think of it as like selling insurance. Basically, when you sell insurance, you enter a series of contracts, you earn steady premium over time, and every now and then you run the risk of default, or in this case, the risk of deal failure or deal collapse. In general, in terms of the characteristics of the strategy, it's characterized by generally low risk profile, low correlation to markets, and as I already mentioned, steady, consistent returns over time. And so, yeah, that's the high level overview of the merger arbitrage.
Traditional merger arbitrage strategies face a whole number of challenges in actual implementation, including things like what deals you're actually going to enter into, how you think about risk managing those deals over a dynamic market cycle. Capital efficiency is another key concern. What are some of the biggest problems that you see in traditional merger arbitrage, and how does AlphaBeta's index seek to address them?
Yeah, so it's a great question. It's a very important question. So the first challenge and the most critical challenge is deal selection. Basically, you want to select deals that will be completed, and you don't want to select deals which won't complete. So you want to pick deals with a high probability of completion. And this is quite critical because if you're selecting deals well, efficiently, your expected return will go up, and vice versa. If you select deals with a high probability of failure, your expected return will tend to go down. Now, traditionally speaking, in sort of discretionary approaches to a merger arbitrage strategy, deal selection has relied on qualitative analysis. Now, this can be really complex, it can often be inefficient, and it's also prone to a wide variety of biases. So the alpha beta index's approach is based on a systematic probabilistic machine learning model, which seeks to estimate the probability of completion for each deal using the latest data and the latest market dynamics. And that way, maximize the probability of completion for, on average, for all deals selected in the portfolio for the index, and to minimize bias as much as possible. The second major challenge would be downside risk. So as I already mentioned, merger arbitrage strategies are broadly characterized by low risk profiles, but the main challenge in these strategies is the risk of deal failure. So what tends to happen is if a deal fails or collapses, the market price of the target company will tend to collapse back down towards its pre-deal price. So this is the main challenge. And in order to mitigate this risk, the index applies dynamic weighting, which means that at each rebalance point, all deals are reassessed based on their updated downside risk, and the positions in the index are recalibrated. The last challenge, which, as you mentioned, is capital deployment or liquidity. Sometimes some deals may be of a smaller size, and this could pose liquidity concerns and challenges for capital deployment. So in order to address this issue, the index has a set of liquidity criteria, and if a certain deal does not meet some of that criteria, its weight in the index may be reduced, and in extreme cases, the deal may be removed from the index entirely. So those are the three major challenges.
You mentioned this machine learning model, and I want to zoom in there a little. How does your use of machine learning in deal selection compare and contrast to traditional discretionary approaches?
So, as I already mentioned, the advantages and disadvantages of a traditional discretionary approach are well known and obvious. In a discretionary approach, you're reliant on subjective analysis, and there's oftentimes human bias, and it could be inefficient. The machine learning approach strives to be completely systematic and seeks to take in all the factors which could contribute to the probability of deal completion, could affect a deal being completed, tries to incorporate those factors and their interrelations with one another to generate a prediction of probability of completion for a given deal, and to select deals in a systematic approach. You can't control everything, you can't know everything, but what you can do is you can try always put the odds in your favor as best as possible. So that's what the index's approach is. Based off a set of factors with historical probability distributions, the index tries to maximize or optimize the probability of completion for all deals selected in a systematic way.
When I look at a merger arbitrage strategy that implements every single deal, it's historically generated an excess return somewhere in the realm of 200 basis points per year. To go above and beyond that, we have to introduce actual deal selection. And so I was hoping you could spend a minute talking about the active deal selection that happens within the index. What criteria does an M&A deal have to meet to actually be included?
Sure. So there are two stages to deal selection or deal criteria in the index. Firstly, there is what we refer to as deal eligibility criteria. And you can think of this as a set of basic criteria or filters or characteristics which deals need to pass in order to be considered for inclusion in the index. So some of these are quite straightforward. For example, payment method. So only deals which are the payment method is cash or cash in stock will be considered for inclusion in the index. This is because if the payment method in a deal is quite complex, that increases the overall complexity of a deal and makes it harder to model efficiently. Another example of a simple criteria would be that deals where the entities are based in China or Russia will be excluded from the index. And this is sort of self-explanatory. You know, a deal where a company is based in China or Russia would undergo far greater regulatory scrutiny. So those are just two examples of eligibility criteria. And using these sets of criteria, the index tries to increase the overall probability of completion for all deals included in the index. After a deal has passed the eligibility criteria, there is a machine learning overlay in which the machine learning model calculates the expected return of the deal based off of its probability of completion and other factors. And only if that expected return meets the index's criteria of the risk-free rate plus 4%, only then will it be included in the index. So just to summarize, it's firstly a set of eligibility criteria. The deal has to be of certain characteristics. And after that, the deal has to be highly attractive in terms of expected return in order to be included in the index.
You can think of this approach as sort of trying to stack probabilities in your favor. So there's an initial layer of criteria that in and of themselves historically have shown to increase the probability of completion, and then the machine learning overlay sort of out of those higher probability events selects even the higher expected returns.
You mentioned this idea, machine learning model versus a discretionary approach. And I think most quants, myself included, would argue that discretionary approaches can introduce unintentional biases. But it's possible for models, systematic models, to introduce biases if those biases exist in the data. And I'm curious if there are types of deals that the model prefers, certain industries or certain deal structures that you tend to find are included more often than not.
Yeah, so the model incorporates a variety of factors and tries to map those factors to the probability of completion and the interrelation between those factors. In general, the model tends to favor deals in which the acquirer is of high quality and the acquirer is of a larger size. It also tends to favor deals which pose lower regulatory concerns. With regards to sectors, the model is sector agnostic, meaning it does not directly favor certain industries over the other. However, there are certain industries or sectors which historically have exhibited higher or lower probabilities of completion. And so sector is one of the variables in the model. The model will take into consideration the given sector for the deal. For example, the utility sector has historically exhibited lower completion rates than other sectors. Another example of a sector with relatively lower completion rates would be the financial sector. So the model does incorporate the historical behavior of certain sectors, the same way it would incorporate the historical behavior of all the other features in the model when trying to estimate the probability of completion. So again, it's not a matter of favoritism towards specific sectors, but it's sort of trying to stack the probabilities in the favor of the index.
I think there's this general idea that it hasn't been a super favorable environment for M&A over the last 10, 15 years, that compared to the prior decade, the number of deals has come down. But if you look on the average, there's actually still been 200 to 250 plus announced deals per year. Your index applies a high degree of scrutiny to these deals. I was hoping you could actually walk us through an example of a deal that was in the eligible universe, but was screened out by the model, and talk through some of the variables that made the model say, no, we don't actually want to include this in the index.
Yeah, so a deal which comes to mind just recently, which is a good example of a deal which passed all the sort of eligibility criteria, but was not added to the index in the very end. So that deal would be Altus Power. It was an all-cash deal, if I remember correctly. The deal itself, as I mentioned, passed all the eligibility criteria, but the probability of completion, which was calculated by the model, was relatively low. And this resulted in a relatively low expected return estimation, which did not meet the index's criteria for inclusion. Now, there are several factors which go into the model when it calculates the probability of completion. But in this case, the main contributing factor was the quality of the acquirer, which is a measure of the historical profitability of the acquirer, as well as the acquirer size. Again, there were other factors, but those were the key main factors in this case. In the deck itself here, we see here an example of a deal which was included in the index. This is when CVS Health acquired Oak Street Health. This was an all-cash deal. It was quite large, and this deal passed all the criteria, and the expected return calculated was very high, and the deal was added to the index, and it was completed in about 3 months. So this is an example of a successfully selected deal which completed successfully, as opposed to the previous deal I mentioned.
As I mentioned a couple minutes ago, when you look at sort of the generic beta implementation of merger arbitrage, it's historically generated an excess return, and it's somewhat cyclical, but in the 200 to 250 basis point range. This index seeks to generate a return, a long-term return of the risk-free rate plus 400 basis points annualized. Can you walk us through how the index is going to go about targeting that return profile?
So this is a great opportunity to emphasize a key feature or characteristic of the index in that it represents a concentrated portfolio of merger deals. So as opposed to an index which invests in all the deals available in the market or live in the market at a given point in time, the Alpha Beta Merger Arbitrage Index seeks to only select deals which are highly attractive. Now, this could mean that the index may go through periods where it is relatively underinvested, and this is due to the fact that the criteria for inclusion are really high. And it can go through periods where it takes on even leverage and it has a higher concentration of portfolios. And this is all done with the goal of selecting deals with the risk where the expected return is greater than the risk-free rate plus 4%. So at a given point in time, there may be very few deals which have an expected return greater than the risk-free rate plus 4%. And there may be other times where there is an abundance of deals in the market with an expected return greater than the risk-free rate plus 4%. But the idea here being is that the index only includes deals where the expected return meets that criteria. And this approach of only including deals which are highly attractive with high expected returns, historically has generated returns which are even higher than the risk-free rate plus 4% over time.
One of the concepts we've talked a lot about so far is this idea of the probability of deal completion. Can you talk a little bit about how it plays into the index methodology and how you actually go about estimating it?
Sure. So this is another really important question. Now, probability of deal completion is crucial. It's essential. Think about it intuitively, again, using the analogy of selling insurance. You wouldn't want to sell insurance to a house which has a high probability of burning down. You would want to sell insurance to a house with low probability of burning down. And it's the same thing here. You want to select deals with high probability of completion and a low probability of failure. By doing so, by selecting deals with a high probability of completion, you will drive up your expected return. So from an intuitive sense, it's quite obvious why probability of deal completion is so important. In a more technical sense, with regards to how and where it is implemented in the model, there are two stages. Firstly, as one of the eligibility criteria, which we discussed, a deal will only be considered for inclusion in the index if its estimated probability of completion is greater than 85%. So if a deal has a probability of completion estimation less than 85%, it will be rejected from the index. Thereafter, the probability of deal completion is used to calculate the expected return of the deal. In simple terms, the index takes the probability of completion multiplied by the spread in the deal, minus the probability of failure times the downside risk in the deal. And that's how the index calculates expected return. So if your probability of completion is high and your probability of failure is low, your expected return will go up and vice versa. So when estimating expected return, probability of completion is critical. With regards to how it's estimated, so it's done using the machine learning model, which takes into consideration a variety of relevant factors such as deal size, deal premium, payment structure, acquirer quality, acquirer size, regulatory factors, and sectors. It takes all these variables into account. It takes the interrelation between these variables into account, and it uses a logistic regression to generate a prediction of probability of completion for each deal.
You mentioned this idea of probability of failure and a deal falling apart. Can you walk through how the index adjusts for this downside risk? What are some of the mechanisms in place to try to mitigate the impact of deal failure, which is ultimately an inevitability?
Right. So it is ultimately somewhat of an inevitability at some point. The index seeks to dynamically adjust weights for deals in which the estimated downside risk would exceed 3% of the portfolio NAV. So that's what it does. How it does it is quite interesting and a bit nuanced. To calculate the downside risk of a given deal, one is taking several factors into consideration. Why? Because, again, it's quite interesting. When a deal is announced, the stock price for the target company tends to behave in a way which is somewhat divorced from the market overall. It tends to behave a lot more like fixed income. And so that means that the market can go up and the market can go down, but the price of the target company won't necessarily move with the market. So when you want to calculate downside risk for a given deal, which is pending or ongoing, you need to calculate how much the deal would drop. The deal will tend to drop from its current price down towards the pre-deal levels, plus what the market has done in that same period. Or in other words, the deal will tend to drop down from its current price back down to the pre-deal level, plus what the stock would have done if the deal had not been ongoing. And so this, you can think of this as sort of like a theoretical price of where the stock would be if the deal did not take place. So in order to calculate that, the index incorporates several factors such as the beta of the target stock to the index and the return of the stock's peer group in that same period where the deal has been ongoing. And so that is how the downside risk is calculated. And then at each rebalance point, the index will recalculate the downside risk for each deal in the portfolio. It will reassess the downside risk using the latest market information. And if at any point a certain deal exceeds, the downside risk of a certain deal exceeds 3% of the portfolio NAV, the weight of that deal will begin to be reduced systematically. And this is done as often as possible to mitigate the risk of deal failure.
And I know on the other side, the deal can actually increase its weight, right? You employ this dynamic weighting system both to reduce deal size and to increase deal size. Can you maybe zoom in a little bit more here, explain how that dynamic weighting system works, sort of dive more into why it's so critical to the design of the index?
Sure. So it can go both ways. If the downside risk increases significantly, the weight of the deal in the index may be reduced. But if the downside risk decreases, meaning the deals become less risky, the weight of that deal may be increased to the maximum sort of weight allocation allowed in the index. And this can happen mostly due to the market movements. So if that theoretical price, which we're trying to calculate, is changed, is moved relative to the current market price, the downside risk has moved or changed. So if the peer group for that stock or the market in general has shot up while the deal has been going on, the downside risk will be going down for that deal, because if the deal were to break, the stock will drop back down to its pre-deal price, but then it will catch up or tend to catch up to what the market has done in that same period. So if the market's going up, downside risk may be going down for a deal in the index. So at each point in time, the downside risk is reassessed. And if the downside risk has gone down for a deal which previously had its weight limited, the weight may be increased for that deal.
At the very beginning, you mentioned this idea that the deal spread is really made up of two pieces. There's a time component, and then there's sort of you could almost say a credit risk component. That's not credit risk. It's sort of the risk of the deal falling apart for regulatory reasons and stuff like that. How does the index handle deals that remain pending for long periods of time? What criteria determine when a deal should be removed? How does the length of time affect the riskiness of a deal?
So very simply, if a deal has been pending for over 300 days, it is removed from the index. Now, this tends to occur with deals which have they're stuck in the mud from a regulatory perspective. The regulator has raised some sort of red flag and the deal is stuck and it can't get through. If a deal is stuck and can't get through, it also tends to mean that the risk of failure is increasing and thereby the expected return is decreasing. Now, if you look at the data historically with regards to time to completion for deals on average, it tends to be between 3 to 4 months. So a deal that's been pending for 300 days is really on the tail end of the distribution. And so by removing these kinds of deals, you can think of it sort of as Windsorizing the data, cutting off the tail risk.
You mentioned this idea that these long dated deals end up being stuck in the regulatory mud. How does the model handle M&A deals that involve regulatory or antitrust challenges? And what impact does those issues have on the probability of deal completion?
Sure. So the regulatory elements are mostly incorporated through the HHI score. The HHI score is a very common measure of market concentration, and it's used broadly by the regulator. It's basically a measure, it takes the squared sum of the market caps of all stocks in a given industry. And if that value, that HHI score is high, it is indicative of high market concentration and a lack of competitiveness in a given industry. So if a deal is announced in a certain industry, the regulator will take a look at the HHI score for that industry, and it will take a look at how the completion of that deal may affect the HHI score as well. And so based off of that score, if it's too high, the regulator might say, no, this deal raises antitrust concerns, regulatory red flags or whatever, and the regulator may look unfavorably upon the deal. HHI is quite important. So naturally, it's included as one of the variables in the machine learning model. So the model does try to map the behavior of HHI to the probability of deal completion, and also map the relationship of HHI to other variables in the model and how they together impact the probability of deal completion. And so if a given deal has a high HHI score, the model should be able to pick up on that and its effect on the probability of completion. But all that being said, one can't control everything, and one cannot enter the mind of the regulator. You don't know on what side of the bed the regulator is going to wake up on. You don't know how the regulator is going to look upon the deal. You don't know how political elements or other elements might affect the decision-making of the regulator. You can only control what you can control, and the index seeks to always put the odds in its favor. So you have a set of variables which historically have had their probability distributions, and they've statistically affected the probability of completion in certain ways. Those dynamics change over time, and the interrelation between the factors change over time. And so the model seeks to capture the behavior of all these factors, maximize the probability of completion estimation, that maximize the accuracy of the predictions with constant retraining and incorporation of the latest data, which represents the latest market dynamics, to try to constantly model the probability of completion effectively and as accurately as possible. Now, HHI is just one of the many variables included in the model.
I want to take a step back a bit from the details and the minutiae to talk about just merger arbitrage strategies in general. And this perception that merger arbitrage strategies, it's like selling insurance. And so people have this idea of it's like potentially picking up pennies or nickels in front of a steamroller, and that steamroller is equity crisis periods like 2008 or 2020. Maybe you could talk a little bit about generically how merger arbitrage tends to historically navigate those types of periods, and then specifically how the alpha beta index is designed to navigate those periods.
Sure. Firstly, the alpha beta merger arbitrage index at all points in time is trying to limit downside risk and mitigate the risk of deal failure. It does so dynamically and systematically as often as possible. But that being said, their merger arbitrage strategies in general have exhibited lower drawdowns than other strategies in times of market crisis. Now, it is true that there is an increase to the beta of merger arbitrage strategies in market crashes. If you take the COVID-19 crisis in 2020, merger arbitrage strategies in that period went down on average about 7%. That's only about a fifth of the drawdown of the S&P 500 in that same period. Also, merger arbitrage strategies in the COVID-19 crisis outperformed bonds, and bonds traditionally are the safe haven in times of crisis. So in terms of market crashes or market crises, the merger arbitrage doesn't perform too badly. And you can see here on the deck the drawdown versus the S&P 500, the merger arbitrage, alpha beta merger arbitrage index performed not too badly during these crises.
The other concern that often comes up with merger arbitrage strategies, especially when you talk about implementing them at scale, is this idea of liquidity, that a lot of the attractive deals are actually smaller cap deals that maybe you couldn't actually put a lot of money into. How does the index ensure investability while maintaining its exposure to attractive deals?
So you're right, liquidity is a concern. So in general, the index has two types of criteria or mechanisms in place to address this. Firstly, as one of the eligibility criteria we discussed, only deals which have a daily turnover above a certain threshold will be included in the index. And what you tend to see is after the announcement of the deal, the turnover for the stock, the target stocks tends to jump anyway. The second mechanism in place is sort of dynamic weight adjustments, in which, based off certain criteria, weights in smaller deals may be reduced, and that's done so as to attempt to ensure that all positions are tradable and that the index as a whole remains investable. So yeah, that's done dynamically all the time. But there is this sweet spot, if you will, between large deals and smaller deals, sort of a sweet spot between the attractiveness of the deal and its size and liquidity. What you tend to see is that larger deals tend to have lower expected returns and lower probability of completion, whereas smaller deals tend to have higher expected returns and higher probability of completion. The problem is they're smaller deals, they're less liquid, it's harder to trade them, they pose challenges in terms of capital deployment. So the index at all times tries to include as many of those small deals as possible to sort of harvest those attractive, high expected returns, still trying to maintain the overall investability of the index. So for a deal to be included in the index, it has to A, be highly attractive, and B, it has to be liquid enough. And so, yeah, that's all that is combined to help ensure that the index remains investable no matter what's happening in all market dynamics and market conditions.
One of the points we glossed over earlier was this idea that the index can actually incorporate a degree of leverage, that the actual weight within the index can go up to 200% long. And leverage is always sort of this double-edged sword, that it can accentuate the good, but also accentuate the bad and the risk. How is leverage managed within this index to balance that pursuit of return enhancement, but obviously not create too much downside risk, or how do you apply those risk controls?
Yeah, so another great question and an important question. So look, very simply, the index at all times is trying to select the best deals. The Alpha Beta Merger Arbitrage Index seeks to only include highly attractive deals in the portfolio. So that approach means that at certain periods of time, the index may be somewhat underinvested due to the fact that there may not be an abundance of highly attractive deals which meet the index's criteria. But on the other hand, there may be periods where there's an abundance of highly attractive deals. There's a party going on. And if there's a party going on, we don't want to miss, the index does not want to miss out on that party. And so the index may use leverage in order to include as many attractive deals as possible. Leverage in the case of a merger arbitrage strategy behaves a bit differently. Well, the effect of leverage is a bit different. What do I mean by that? Traditionally speaking, with a portfolio, let's say if you're trading equities, if you increase the leverage, your risk will tend to go up proportionately. But the thing is here that each deal that you add to the portfolio in a merger arbitrage index is almost entirely idiosyncratic and has a low correlation to the other positions in the portfolio. So by adding more deals, by increasing the leverage, you don't necessarily increase the risk profile of the overall portfolio. So the index is able to add more deals, increase the expected return without necessarily increasing risk profile of the overall index by very much. And so using this approach of only selecting the most attractive deals, historically, the index has been able to achieve superior risk-adjusted returns to other broader indices.
And maybe you can talk a little bit about a compare and contrast of index design versus other indices that are in the market, either broad hedge fund indices or other systematic bank indices.
The key differentiator here, in simple terms, is that the Alpha Beta Merger Arbitrage Index employs more of a hedge fund approach. So what do I mean by that? As opposed to an index which would trade all the deals or be fully invested all the time, the Alpha Beta Merger Arbitrage Index is highly selective with regards to which deals it includes in the index. It's sort of like a hedge fund would pick stocks, the Alpha Beta Merger Arbitrage Index picks deals. And it's very, very selective in the deals which it picks. Now, this might cause periods where the index is underinvested, which might seem to cause periods where the index underperforms in comparison to other broad indices, which are invested in the whole mergers and acquisitions market, if you will. So this might be especially pronounced in periods of mergers tailwind, where there's an abundance of deals. The Alpha Beta Merger Arbitrage Index may seem to underperform for certain periods. Also, additionally, the return profile may seem at certain periods to be asymmetric. So because the portfolio is concentrated in highly attractive deals and not trading all the deals, certain deals in the index may only get completed towards, for example, the end of the calendar year. So for a few months, the index may seem to outperform, and then over a shorter period, outperform. In that way, the index could achieve or aims to achieve its long-term goal of the risk-free rate plus 4%.
Two follow-up questions that came to mind to me as we were going through this conversation. One is, you mentioned this idea that the underlying model is constantly being retrained on data all the time. One of the questions I would have is, how often do you expect the actual model itself to change? I know you recently introduced a new explanatory variable. How often do you go back to the research and say, oh, there's actually something that we can add that can make that model more accurate in its historical analysis of the probability of deal completion?
Sure, I'll happily answer that. So we are constantly reassessing the model. And at regular points, we update the data and retrain the model. We can see how the coefficients and weights assigned to each variable have changed and how the model performs overall, what the average accuracy of the model might be. So we're constantly reassessing that, and we're always looking to improve it, where it's tracking all the deals as they're announced, and we're always trying to optimize the performance of the model.
In general, as I mentioned at the beginning of the conversation, we keep refining our approaches over time, and especially with the research, academia going into this space of machine learning and AI and new tools and models being introduced, we want to keep track of those developments and see if we can do it better. The model used in the index, logistic regression, is relatively speaking pretty simple model, but there are always improvements and other approaches that's been going on, and we're trying to keep track of that.
And just sort of last point of clarity, can you provide the inception date of the index and then also talk about when you as a firm started running live merger arbitrage strategies and maybe sort of connect those for me on a timeline?
So the index inception date, if I'm not mistaken, we started the go live in December of last year, or maybe a bit before.
I believe it was December.
Here we started implementing the merger arbitrage about 3.5 years ago, live.
Perfect. Gentlemen, I really appreciate you taking the time. If folks want to learn more about Alpha Beta or the Alpha Beta Merger Arbitrage Index, where can they learn more?
Sure. So we have the website alpha-beta.co.il. You can hit alternative indices there, which will take to the index provider website. There are the methodologies there, explanation, research notes, so a lot of materials and stuff that could be used there.
All right, gentlemen, I really appreciate you taking the time today. Thank you so much.